Tonight, as the Asian markets open, the entire global silver market is holding its breath. And look, we're not talking about your typical market jitters here. Something is fundamentally broken, and all the data suggests that something is about to snap. So let's get right into it, because what happens in the next few hours is going to force this market to make a choice between paper promises and physical reality. And it really all boils down to this one number, 91%. That is the absolutely staggering gap that's opened up between what one part of the world says silver is worth on a screen and what another part is actually paying to hold the real metal in their hand. I mean, how can that even happen? That's the core of the mystery we're going to unpack right now.
Okay, so you got to understand there are really two different worlds for silver. You've got paper silver, which is just a contract, right? It's a digital promise that gets traded back and forth on exchanges. And then you have physical silver, the real deal, the actual bars and coins sitting in vaults. The thing is, right now, those two worlds are telling completely opposite stories. And tonight, well, something's got to give.
So how did we get here, right, on the edge of this cliff? Well, it starts with what you might call a pressure campaign, one that's happening just behind the scenes, targeting the very people who trade silver.
To really get what's happening, we need to talk about something called a margin requirement. Think of it like a security deposit on an apartment. When you trade a futures contract, you don't pay the full price of all that silver. Instead, you put down a small deposit, the margin, to control it. But what happens if the exchange suddenly tells you that deposit needs to be way, way bigger? All of a sudden, it gets incredibly expensive just to hold on to your position.
And that is exactly what just happened. The Chicago Mercantile Exchange, the CME, they didn't just raise the margin. No, they jacked it up, not once, but twice. Back to back, all within a 72-hour window. I mean, that is not a minor tweak. That is a deliberate, aggressive tightening of the financial screws on anyone holding silver.
And just look at what that actually means in dollars and cents. Before this happened, the deposit to hold one silver contract was around 25 grand. After the two hikes, it skyrocketed to $66,000. It more than doubled. For a lot of traders, that's not just an inconvenience, that's game over. It's a financial wall designed to force them to sell. Now, the official story from the CME is that this is all just risk management because of the volatility. But a lot of people in the market aren't buying it. They see this as a calculated squeeze play. The timing, right after a big price drop, seems convenient. The goal, they say, is to make it financially impossible for the little guy to hang on, forcing them to sell and pushing that paper price down even more. Okay, so remember that. All this pressure is pushing the paper price down. But at the exact same time, something completely different is happening in the real world. The actual physical metal, it's vanishing. The vaults are literally running dry.
And look, this isn't just some rumor floating around on the internet. These are hard facts from major players. Bullion Star, a huge global dealer, is telling people it's uncertain if they can even get more inventory. Golden State Mint just halted silver sales entirely. And over in the UK, the biggest dealer in the country, Baird & Co., stopped all online sales. These are giant, flashing red alarm bells.
And this brings us to a really key concept. This is what the experts call a market dislocation. It's when the price you see on the screen has totally detached from the reality on the ground. You've got these two powerful forces pulling in completely opposite directions. And that can't last forever. And if you want to see just how extreme this has gotten, this is where it gets really wild. Let's look at the actual prices, because that little gap we talked about, it's become a massive canyon. Okay, check this out. On the COMEX exchange here in the US, the main hub for paper silver, the price is about $85 an ounce. But in Shanghai, if you want the physical metal, you're paying over $122. And on JD.com, China's biggest retailer, people are paying over $163 an ounce. That's a 91% gap. They are paying almost double to get their hands on the real thing. But wait, it gets even crazier. If you ignore all the trading noise and just look at the simple economics, how much silver is being mined versus how much is needed for industry, for jewelry, for everything, its fundamental value should be somewhere around $130 an ounce. So what does that mean? It means the US paper price isn't just a little low, it's trading at a massive historic 30% discount to what it should be worth. And that 30% number, that is the magic number. Because if you look back at history, every single time this has happened, every time that discount has gotten this big, the market has violently corrected itself. Not most of the time, every single
time. History is basically screaming at us that a gap this wide is unsustainable.
Which brings us to tonight. Because as the Asian markets fire up, all these different threads, the squeeze, the shortage, the price gap, they're all about to collide in real time. The reckoning begins. So let's just recap the three huge forces on a collision course. First, you have the margin squeeze, putting unbelievable financial pressure on traders. Second, you have the undeniable physical shortage, where dealers literally can't find the product. And third, you have this insane price dislocation with a 91% gap between the promise and the reality.
So what's going to happen? It really boils down to two main possibilities tonight. Scenario A is the snap up. Physical demand just overwhelms everything, and the paper price is forced to rocket upwards to close that gap with reality. Scenario B is the snap down. The margin squeeze works. Forced sellers dump their contracts, and the paper price craters, making that chasm between paper and physical even wider.
But here is the absolute key to understanding this. Even if we get that snap down, it doesn't fix a thing. It just kicks the can down the road. In fact, it makes it worse. All it does is stretch the rubber band even tighter. It just means that when the correction finally does come, and it will, it's going to be that much bigger and that much more violent. Either way, something has to break. And all of this really leaves us with a huge, fundamental question that's about way more than just silver. When the digital promise of an asset becomes completely disconnected from its physical reality, and the market itself can no longer agree on a single price, what is anything truly worth?